To kick off, it would be good to find out a bit more about how specialist lenders, up until the pandemic, have historically assessed loans for self-employed borrowers, and how accessible this type of finance was beforehand, just so that we can kind of set the scene of the contrast. So I don't know if Alice, if you wanted to kick us off with an answer on that one, and then the lenders can chime in.
Yeah, so the last couple of years, borrowing money as someone who's self-employed, as long as you've got the right paperwork in terms of tax calculations and accounts, actually has been relatively simple. There's always a perception of the market that being self-employed was a problem. Well, if you're not paying any tax, that is a problem, but if you pay it at the right level, actually it's absolutely fine. And especially over the last 18 months, lenders are getting slicker and slicker around applications. Often we just need to have 2 years SA 302s, tax calculations or accountant's reference to sort of fast forward a situation now where actually it's much harder because lenders are asking many more questions. If you're employed and your income is carried on, lenders treat you as the same because your income is still there. It's more that if you're now self-employed, a lender's going to be much more forensic in understanding your business, your sector, your cash flow, ask you for many more things. Whereas before, it would just have been, here's the latest set of accounts. As long as they are within 18 months, we'll work off historic figures. We don't care about business bank statements. We're just happy with your credit score, your proof of income, and your ID and proof of address, and we're good to go. And now it's a very different market.
Matt or Stephen, do you have anything to add to that?
Yeah, so I just want to say that, like, we're one of the lenders that in a specialist arena try to make it proactively positive for self-employed would-be borrowers. We created our own proposition around the self-employed, and really marketed and actively sought the business, in particular where sort of like would-be entrepreneurs want to enter the mortgage market. For example, your first-time buyers who've had latest year's income growth, we're looking to use the latest year's income to fund these all the way to the high LTV mortgages. Like Alice said, though, we've got to take some more risk-based approaches at the current time, which I'm sure we'll discuss later, but the LTVs have been tapered back and so on and so forth. But we've made it, a lot of lenders have made it a lot easier to supply finance to self-employed borrowers. So it's a good positive.
Yeah, I think I'd agree with that. The lenders have been very positive about self-employed, and I think that they'll do their utmost to continue to be so. But as the participants have said, it's inevitable that we're going to be a bit closer at the sector they're in, their own personal circumstances, and if they, how much unfortunately they've suffered during the period, during the lockdown, how much debt they've built up, how long it will take to recover their particular business. And unfortunately, it's not quite as easy as just seeing what sector they're in. It'll be much more nuanced than
that. And then now, like since the UK has gone into lockdown, how and why has this affected the way that specialist lenders assess self-employed lending across all different types of finance? So we can look at mortgages, buy-to-let, commercial. In addition to that, how have timeframes and costs changed now?
Well, I think nobody wants not to lend. Everybody wants to lend. They're starting from that position, but at the same time, clearly there's a responsibility not to lend to people who are going to struggle to make payments. So you're going to be more intrusive about people's circumstances because you don't want to lend to somebody who can't afford the payments. Ultimately, it's going to be much more difficult to assess future income from past income because they don't need to point out the world's changed quite significantly. And there is a responsibility, isn't there? Because if you take on finance or mortgages you can't afford, it's really stressful. So nobody wants to put anybody in that position. At the same time, we don't want to deny people who are going to be able to afford it the opportunity to borrow as well. So there's going to be a much more intrusive process, unfortunately. But I think the industry will approach it positively because we do want to lend.
Yeah, and I think that you look at, clearly it's very different, but I think there are parallels between now and after the recession, 2008, 2009, where the world changed very quickly, and lenders and brokers had to adapt. And I think we're seeing that now with during lockdown, a lot of lenders were very proactive, using things like automated valuations, allowing people to work from home, business to continue. all of that I think is very positive. But to answer your question, Beth, timescales are going to be elongated. It's going to take much longer to underwrite cases, much longer to investigate, because if you're now asking very specific questions around the sector, the business itself, the location, what plans you've put in place to future-proof yourself. I mean, no lender on a residential basis would ever have asked that. Those are kind of questions that would be asked on commercial lending, on quite big commercial lending. And suddenly we're asking those questions on a £300,000 mortgage on a £500,000 house, which would never have been there. But suddenly they're very pertinent because we want to make sure that that company has done everything they can to mitigate the worst of lockdown and mitigate the worst of the situation and put themselves in the best place possible. And that's where it's going to become time-consuming and expensive, because we're going to have to much more around how we present this. And it's I think also where client accountants come to this as well, where we're going to have to be much more proactive and much more innovative around this. I mean, Jonathan, what do you think about that?
Well, it's really interesting because I think there's lots of things that come from this, and I think we're obviously in the very early stages of the economic impact of the pandemic. So that being said, I think that there's a responsibility from the borrower as well as the lender to be as transparent and as forthcoming with the information. And that comes with the communication between borrower and lender. And that's where obviously the accountant can help as well, because we can help bridge the gap in terms of understanding what the lender requires and be able to relay that to the client. Because a lot of the time someone will just think, this is a residential mortgage, this is what I earn, this is what my business has done, and therefore I should be able to get a mortgage really quickly and money is cheap. The world has moved on from that, as you guys have explained, and the borrower needs to be aware that this is a process that is going to require a lot more information flow and a lot more thought, so that the lender can have some comfort that the person who they are lending to actually really understands her business, and that they feel that this is a good credit risk, that you understand your business, you understand the factors that can affect the business, and therefore we can underwrite this because we feel more comfortable that your business is viable. And that's really sort of what we're seeing at the moment, and the type of information I actually think is a good thing, because I think it will underpin more sensible borrowing rather than just taking money for money's sake.
Yeah, I'd agree that, and one of the big changes that sort of we're facing into now as lenders when underwriting these sort of mortgages is that third position that you've got to look at. Before, you've always looked at the person and the figures. Yeah, as long as everything lines up there, the loan can kind of get where it needs to be. Now you've got to look at the industry they work in and understand what impact does that have on them figures. And one of the examples that we've put into play at Aldermore is asking the borrower, the would-be borrower, to sign and confirm a declaration form upon the application that literally just asks a couple of questions around, if they're employed, we'll ask them, has their employment been affected by COVID-19? If so, and how? Same with self-employment, if it's been affected, if so, and how? If it's been affected, kind of things that we'll see is obviously usual things. You can imagine you drop in income, your loss of earnings, the loss of trade. But actually, one of the key things that we ask is, what's the contingency plan that you've got in place? Because a lot of these people have sufficient savings and plans that cover that gap. And they're the borrowers that are still going to get these mortgages quite easily. It's the ones that unfortunately don't have that and may be open to more risk. Hence why a lot of lenders have also pulled back from various elements of capital raising on their mortgages to ensure people aren't exposing themselves to take money out of low equity properties just to cover the gap and become the contingency. But we do have quite a proactive process. We are getting a lot closer to the affected industries, and we want to be as proactive as possible to make sure we can lend. And so far, I'm pleased to say that we're doing quite a good job at it.
I think part of the problem with that, though, is that the borrower nor the accountant has a crystal ball. And Alistair quite rightly referred to the impact of 2008. My feel is that this is different to 2008. in that this affects everyone. 2008 was a credit crunch. This is something that is affecting everyone, unless you're fortunate enough to be supplying PPE. You know, your industry, your business is going to be affected. What we don't have is a crystal ball to say, when will the new, you know, when will normal return? What does normal look like? You know, if you run a restaurant, for example, you run 100 seats, how many are you going to be allowed to have? We still don't have clarity on that. So, you know, someone who's putting a forward-looking projection, do they base it on 30%? Do they base it on 50%? Do they base it on 0%? And that's the issue at the moment, is that there's a lot of unknowns, and therefore there's going to have to be a pragmatic approach. And I think that exactly what you said is, we need to lend, but what contingency do you have in place? Because as a lender, that will ultimately give you the comfort of what security do we have when we lend.
As the restrictions are slowly lifted and businesses can get back to work, are lenders further changing the way that they underwrite specialist mortgages and loans for self-employed borrowers?
I think, well, we're going to have to change. As it all develops, it will change our views, won't we, on different sectors. And I think, as you've said about restaurants, it really matters, viability to restaurants, whether they can open the next, let's say, the next 6 months 50% occupied or 80% occupied, because that's the difference between making money and not making money. So it's going to change week by week, because we keep getting announcements that some of which are unexpected, and you have to think about the consequences of that. And so on, and hopefully in the next few months it all gets clearer and there's not a second peak of infection which would then throw it all back into turmoil. But we all have to be, you know, we have to be fleet of foot, aren't we, and keep assessing our views as we go along. I think the point about projections is very valid. You know, accountants providing projections, it's all about the assumptions that are being made when those projections are produced. As to how useful or otherwise they might be to a lender to judge what the future might hold.
I think the point you made there, Stephen, about being nimble, it's so key, and I think that's where lenders like, you know, Market Harbour and Alderman will pick up business, because you're able to make decisions. You're able to have underwriters who can look at the entire case and make a judgment call, as opposed to a larger, more warehouse-type lender, where it's essentially a process, and if boxes aren't ticked, it doesn't fit that process, it becomes much trickier. It was definitely interesting to see if some of the larger lenders do become more nuanced and do start to look at cases in much more detail, apart from just looking at business bank statements, just looking at the whole remit of projections and business plans and contingencies and everything else. Or whether they just shut up shop and say, look, we don't have the capacity or the appetite for risk for this, and effectively they just close their doors to you know, vast swathes of clients on the basis that it literally isn't worth their while. Which, if that's the case, that's disappointing, because then it's obviously we've lost a number of lenders for a large section of clients. But luckily we do have access to a whole range of specialist lenders who hopefully will pick up the slack on that. You know, I suppose from your point of view, if for example you had an extra sort of 50% increase in inquiries and applications because large lenders weren't, I mean, is that something you have to cope with, or is there going to be an issue around capacity?
Well, I suppose it depends on how many withdraw. I don't believe they'll withdraw because it's too big a proportion of their overall business, surely. But there's going to be some circumstances which they won't be able to deal with, and the specialist lenders will pick up. So it's normally our practice with people with particularly complex circumstances or uncertainty over the future, for underwriters to speak direct to the clients to try and help their understanding of what the future holds. And as we've said before, you know, what the contingency is if your assumptions about the future prove to be incorrect, how resilient will you be? Or can you be in those circumstances? How would you plan for that? And I think you can get a lot of comfort from talking to people who clearly thought it through and know what they're going to do should things not work out as they hope. So that I find the big lenders will find that a difficult process. So I would anticipate that the more people with self-employed people with more complex circumstances that might have been dealt with by large lenders will now move into the specialist lending market. But I don't think the specialist lending market can pick up everybody who's self-employed going forward at all. But I don't think that'll be necessary. They'll adapt.
They will, and I think so. The big elephant in the room at the minute for every lender is actually, in fact, the mortgage payment holiday scenario, which an extreme amount of people that are exposed to that are naturally going to be the self-employed borrowers. Now, it's one of the things that really stands out to me in this current crisis we're in is self-employed borrowers moving forward now really have to get deep into the business plan and look at what these contingencies are and continue to be. So the same way that any working environment would have, let's say, an office environment, they'd have a contingency plan for things like this to drop back to working at home, to look at their different business models. The same has to apply for a self-employed borrower. Yes, we've been dipped into an extreme crisis here, a pandemic globally, but actually, going back to Stephen's point, this dreaded second wave, people now have to set themselves up in case there is a second wave so that it can continue to trade to the maximum capacity in line with any guidelines that's there, rather than go through this potential 11, 12-week void where nothing can happen or nothing's been planned for. So I think that'll be the future of it. I think lenders are already by default pushing ourselves that way by asking people for their contingencies as it is, and also moving forward, not just for the affordability of the mortgage and the lifestyle that they've got on a page, but actually to cover the risk of us exposing ourselves to a customer that may not be able to pay back straight away. And that then drives forward another point Stephen quite rightfully raises, capacity, which is, I think a lot of lenders right now probably could be more proactive in different areas of specialist lending. But like I say, the elephant in the room is the capacity we're having to sacrifice to help these borrowers that unfortunately can't currently repay their mortgages and have had to take these breaks.
But I think the thing is from that, which I find quite an interesting situation, is that mortgage applications have always principally been based on historical information. For the first time, there's now a real focus on future information. And whilst there's some uncertainty, I think, again, I find that to be a positive change because history can tell you what the future should look like, but actually it doesn't guarantee anything. And lenders have been prepared to lend based on historical information without a real focus. I mean, the references have normally been around, do you anticipate there to be any changes in the future? Do you foresee any? And there's a whole realm of caveats that we as accountants can use to cover ourselves, to cover the client. But actually now, by forward looking, it actually gives you guys the opportunity to say, well, that's what they have done in the past, but what is the feeling about the future? What can we sense from this type of client and lending risk about what the future looks like? And I find that is going to be quite an interesting change in the lending environment.
Yeah, I think it represents opportunity as specialists, doesn't it? Because there will be more people who need proper underwriting, who need an open discussion direct with them, who need to be challenged on what their future plans are to make sure that we're doing the right thing. So it's, in a way, it's a good thing to, as you say, to get away from just entirely relying on the past, because the past is no longer, at least for 3 or 4 years, is it, a guide to the future. But you can make reasonable, assumptions and judgments in everybody's best interests as to what might happen in the next 2 or 3 years. And every week it gets a little bit clearer, doesn't it, as to what that might be.
It also made delays in the underwriting stages for self-employed borrowers for buy-to-let and commercial mortgages.
I think delays are around the challenges of working off-site, but I think my understanding is that most people have now overcome that. They've got, they're nearly or just as efficient as they were when we were all sitting in the office. It just took a few weeks to get over that. But yes, but having to have a conversation that goes back and forward through intermediaries or through accountants or whatever, just slow things down. So we normally find it's best to try and talk to customers direct, and have an open conversation about circumstances and plans and whatever. And you get a lot more comes out of those conversations than you might imagine, as to they'll reveal their contingencies to you that you maybe weren't aware of. It gives you comfort, hopefully, as to proceed. But yes, it takes longer than spending 5 minutes looking at their last 3 years' tax returns, without a doubt. Yeah.
Well, that's the key, isn't it? Because suddenly, because we're having to ask all these other questions around the future proofing of that business, which, as you've all mentioned, we would never have asked before. We would have just gone off the accounts, the reference, all the caveats have been fine. Yeah, all seems to be good. And now the underwriters having to spend 2, 3, 4 times longer going through everything. The client's having to provide, instead of providing 5 documents, suddenly they're providing 15 documents. The accountant's having to provide a more nuanced reference plus projection plus a whole range of other stuff. And suddenly the packaging goes from our point of view, goes from being reasonably slim to being much greater. So we're all effectively doing more work to get to the same situation as before. And I think it's just managing the client's expectation around the extra potential costs involved, and certainly the extra time involved to get this moving forward. And as long as they're happy with that and they understand it, fine. But they can't be expecting that we're going to get an offer out within 3 or 4 weeks, because that isn't a world we're going to be in now for a while.
And the lender delays, they sort of add to the mortgage journey inevitably. But actually, what people don't always consider is the front end delays. So meeting with the clients, having that more in-depth conversation, having to do more work around what they're looking for. Whereas before it could have been, a pretty much potentially vanilla, self-employed mortgage, buy-to-let landlord or an individual owner occupied. Now it's a little bit more detailed, takes a bit more time. And actually, though, this is now a perfect time in my eyes for the intermediary market to stand out. It's already valued exceptionally. But actually, one of the things that I'm really campaigning at the minute is, we're good specialists in buy-to-let as well as a self-employed at Aldermore. And one of the things that we are really campaigning at the moment is getting closer to your full-time self-employed landlords. Because as an intermediary, what you could see potentially becoming an indirect business partner with a landlord, right? And the example is that if you've got, in my eyes, I've got a close friend of mine as a landlord, and they're exposed to quite a few student lets and HMOs. Now, as we know at the minute, no one's going to any sort of higher education. In fact, there's a big debate at the moment on who deserves education currently, because unfortunately some people that are, in some people's eyes, really extremely, important in the education sector, your higher educations, your final year in school, they're being neglected. I think from the landlord's point of view, who are overly exposed to the area of student lets, multi-sharing properties, they may be a thing of the past. And, even in the current climate now, some people are thinking whether or not they're going to go back to universities. Are universities going to merge and then become more digital, which then puts a huge strain on the buy-to-let market? At that point, then it's an intermediary's job to potentially, in my eyes, look at the future and think, right, how can we adapt and potentially diversify your portfolio a bit that makes it more risk-proof in future, not just for yourself, but also to get funding for lenders as well.